Your dollar didn't quietly lose 10% of its power, it was taken. Something triggered this, something hidden. And the moment you understand what it is, you lines realize we're much closer to a financial breaking point than anyone is willing to admit. Right now, as the Federal Reserve begins cutting interest rates after the fastest rate hike cycle in modern history, something extraordinary is happening behind the scenes. Gold has surged to all-time highs, silver is rising at a pace that analysts haven't seen in decades. And central banks around the world are buying precious metals at a level not recorded in more than 70 years. This combination is unprecedented. It has never appeared together at this scale in modern financial history. And yet, most people have no idea what it means, or why governments, banks, and global institutions are preparing for something the average person hasn't even noticed. To understand the truth, we have to go backward, back to decisions made in secret rooms. Back to the quiet policies that reshaped the world. Back to the moments when a single mistake, a single crisis, or a single political decision created ripple effects that still haunt the system today. Because what we're seeing now, the rate cuts, the surge in gold, the decline in purchasing power, isn't random, it's part of a pattern. A pattern we've seen before, repeated across history, in every currency collapse that came before the dollar. Every financial downfall begins with the same illusion. Confidence. Confidence in a currency, in a government, in an institution. And that confidence holds until one day it doesn't. In 1971, the world watched that illusion shatter when President Richard Nixon ended the convertibility of the dollar into gold. Overnight, the dollar shifted from a metal-backed currency to a promise-backed one. No gold, no physical anchor, just trust. Trust in policymakers, trust in stability. Trust that the system would never lose control. Few people realize that this moment created the foundation for every inflation crisis of the next 5 decades. It unlocked unlimited borrowing. It allowed money creation without limits. It turned the financial system into a machine fueled by debt. But here's the part almost nobody talks about, the decisions that led us here, to this exact moment of record gold buying, soaring silver, and emergency rate reversals, follow a predictable pattern. The pattern is always the same, a rise. A strain, a break, a desperate fix, and the fallout. Right now, many experts believe we are entering the strain-to-break phase again. But before we understand today's crisis, we have to trace the origins. After World War II, the United States emerged as the world's economic superpower. The dollar became the global reserve currency under the Bretton Woods Agreement. It was backed by gold, trusted by nations rebuilding their economies. For years, the system functioned flawlessly, until the cracks started forming. By the late 1960s, the US was printing more dollars than it had gold to support. Other countries noticed and began demanding gold instead of paper. Confidence faltered, pressure built, the strain grew impossible to hide. Then came August 15, 1971, the breaking point. Nixon closed the gold window, the dollar floated freely. And a new era began, an era built on debt, expansion, and inflation. Whenever trust in policy weakened, gold strengthened. Whenever the dollar slipped, silver surged. The pattern was in motion. Through the 1980s and 1990s, confidence in the dollar remained strong. Debt increased, foreign investment ballooned, and interest rates swung wildly, but the illusion of control remained. Every empire believes the same thing: our currency can never fail, until it does. And the same forces that once made the dollar strong are now the forces pushing it toward a new breaking point. The rise of the dollar from the 1980s onward wasn't just an economic event, it was a psychological one. It shaped how the world viewed money, power, and safety. The dollar became more than a currency. It became a symbol of stability, a financial North Star that nations trusted even when they didn't trust each other. But like every symbol built on confidence, its strength wasn't in what it was, but in what people believed it to be. Throughout the 1990s, globalization accelerated. Countries everywhere started storing dollars as reserves. International trade ran through dollar pipelines. Corporations borrowed in dollars, banks hedged in dollars, and governments held U.S. Treasury bonds as the ultimate form of safety. The system grew, expanded, multiplied, and with every transaction, America's financial influence surged. But beneath the surface, something else was growing too. Debt. By the year 2000, total U.S. debt, government, corporate, and household, had reached levels that previous generations would have called unthinkable. But nobody noticed, nobody cared. Debt didn't matter because the dollar was strong. The economy was booming, and the world was convinced that the U.S. could borrow forever. That illusion shattered in 2008 when the global financial crisis hit. Confidence cracked just like it had in the late 1960s, but this time, instead of changing course, the system doubled down. The Federal Reserve began printing money on a scale that had never been seen before. Quantitative easing, a term almost nobody had heard before, became the foundation of modern finance. Trillions of dollars flooded the economy. Banks were bailed out, markets were rescued. And the world breathed a sigh of relief, but the cost of that relief was enormous. Every new dollar printed diluted the old ones. Every bailout shifted future risk into the present. Every rescue required more debt, more expansion, and more promises that the system could never keep. The fallout didn't come immediately. In fact, for a while, the opposite happened. Stocks soared, real estate exploded. Corporate profits reached historic highs, the dollar remained king. But the foundational cracks were widening, quietly, invisibly, relentlessly. And then, in 2020, the greatest stress test of modern finance arrived, the global pandemic. To prevent total economic collapse, governments unleashed stimulus spending at a level that dwarfed 2008. More money was printed in a single year than in the entire first century of the Federal Reserve's existence. Trillions entered circulation. People received checks for staying home. Corporations received relief funds. Banks received support. Markets received protection. The system didn't just expand, it inflated like a balloon pulled near its breaking point. At first, the effects felt positive. Markets bounced back instantly. Asset prices shot upward. The economy looked strong. But the inflation that followed was unavoidable. Prices climbed at the fastest pace in 40 years. Everyday necessities doubled in cost. Savings evaporated. And the purchasing power of the dollar began to erode at a speed that even mainstream economists didn't predict. Yet, even then, the real story wasn't inflation itself. The real story was the reaction that came next. To fight the inflation crisis, the Federal Reserve launched the fastest interest rate hike cycle since the early 1980s. Rates surged from near 0% to above 5% in record time. It wasn't just aggressive, it was desperate. And desperation always creates consequences. Higher rates froze real estate, they crushed small businesses. They distorted credit markets, and, most importantly, they triggered massive stress inside the banking system. Several U.S. banks collapsed, billions in deposits vanished overnight, and once again, behind closed doors, the same question began circulating among global institutions: what happens if the dollar system breaks? That question led to the next phase of the pattern, a phase unfolding right now. As rates squeezed the economy and the dollar's purchasing power dropped nearly 10% in 6 months, central banks around the world began acting. Not with words, not with statements, but with quiet, strategic moves. They started buying gold, not a little, not occasionally, but aggressively, at the fastest pace since the early 1950s. Countries like China, Russia, India, Turkey, Egypt, and Brazil increased their gold reserves dramatically. Even U.S. allies began diversifying. For the first time in decades, nations weren't just storing dollars. They were slowly, methodically, hedging against the dollar. Gold became their insurance policy, silver became their signal, and the record-breaking purchases were a warning. The world was preparing for the possibility that the dollar might not remain dominant forever. This wasn't speculation, this wasn't theory. This was behavior, the purest form of truth in markets. Because countries don't move billions into gold unless they sense a long-term shift coming. Then came the next sign, the Fed pivot. After pushing rates to their highest level in decades, the Federal Reserve finally began cutting. Markets celebrated, analysts cheered, but behind the optimism, a darker question lingered. Why cut now? Why reverse course before inflation is fully controlled? Why ease monetary policy when the dollar is already weakening? Some experts believe the answer is simple. Something in the system is breaking again. Maybe it's the banking sector. Maybe it's the treasury market. Maybe it's the debt spiral that is finally catching up. Or maybe it's a combination of all three. Whatever the trigger is, gold markets reacted instantly. Prices shot to new highs, silver surged, investors moved into hard assets, and global confidence in U.S. financial stability began to quietly fade. This is where the pattern completes its loop. A rise, a strain, a break, a desperate fix, the fallout. Each phase leads to the next, building pressure until the system can no longer contain it. And right now, every sign, every metric, every indicator, every historical parallel suggests we are entering the fallout stage once again, but this chapter is different, because for the first time in modern history, the world has alternatives. The rise of digital currencies, commodity-backed systems, and global trade networks outside the dollar structure means the US no longer holds the same uncontested power it once did. And that changes the stakes entirely. The question is no longer, will the dollar weaken? The real question is, what happens when the world no longer needs the dollar the way it used to? The last time a global reserve currency collapsed, the British pound in the mid-20th century, it didn't happen overnight. It happened slowly, then suddenly, quietly, then violently. Predictably, but only in hindsight. Today, the same forces are gathering again. But with a key difference, the scale is far larger, the stakes are far higher. And the global financial system is far more fragile. The events you're seeing right now, record gold buying, rising silver, rapid rate cuts, and a weakening dollar, are not isolated events. They are signals of a trigger, signals of transition, signals of a system nearing another turning point. And the most important question becomes, what sets off the next phase? We'll explore that next. To understand what might trigger the next phase, we need to look at the weakest points of the system, the places where pressure builds silently until the structure can no longer hold. And just like every major financial unraveling in the past, the next breaking point will likely emerge from a place most people aren't watching. Because collapses don't start with the obvious cracks. They start with the hidden ones. Take the US government's debt, for example. For decades, it grew steadily, predictably, and somewhat harmlessly, or at least that's how it seemed. But in the last few years, that predictable rise has turned into an explosion. Trillions added year after year. Interest costs soaring to record highs, debt rising faster than GDP, and, perhaps most alarming of all, foreign buyers slowly stepping away from US treasuries. This is not a small detail. For over half a century, the world financed America's spending. Countries like China, Japan, and major European nations bought massive amounts of US debt because they trusted the system. They believed the dollar was safe. They believed the US government would always be stable. They believed treasuries were the world's safest asset. But those beliefs are fading, quietly, gradually, but unmistakably. Foreign demand for US government debt is at one of its lowest points in decades. Countries are reducing holdings, diversifying reserves, and investing more in commodities and gold. The very nations that once kept the dollar dominant are now hedging against it. Without strong global demand, the US must finance more of its debt internally. That means more money creation, more borrowing, more inflation risk, more pressure on the dollar, and more reasons for gold and silver to surge. But this isn't the only pressure point. Banking stress is building beneath the surface again. When interest rates rise as fast as they did, the value of long-term bonds collapses. Banks holding those bonds face massive unrealized losses. Some can survive it, others can't. We saw the first cracks in 2023 when multiple regional banks failed within days. But those failures were not isolated events. They were warnings, early tremors before a larger quake. Many institutions still hold the same toxic combination of weak assets and expensive liabilities. Rate cuts relieve some pressure but create others. Lower rates reduce bank losses, but they also signal that economic conditions are worsening. And when the Federal Reserve cuts aggressively while inflation remains elevated, it sends a message that stability is slipping out of their hands. Every decision the Fed makes now is a trade-off. Fight inflation and break the system. Save the system and weaken the currency. There is no middle path anymore, only choices about which damage happens first. And that brings us to the third pressure point, global realignment. For decades, the world revolved around one financial center, the United States. But now, new alliances are forming. Major powers are trading in local currencies. Nations are forming economic blocs designed to bypass the dollar. Oil deals are being negotiated without the petrodollar framework. And the BRICS nations, once dismissed as symbolic, are now expanding, pushing forward with initiatives built on resource-backed settlements. These shifts are not sudden. They have been developing quietly, year after year. But in the last 24 months, they have accelerated dramatically. And acceleration is always the final stage before transformation. All three pressure points are debt, banking fragility, and global realignment are converging. And when pressures converge, triggers appear. Some analysts believe the trigger will be a sudden debt crisis. Others think it will be a major bank failure. Some point to a geopolitical conflict. Others to a credit freeze or a bond market panic. But the truth is simpler. The next trigger will come from whatever part of the system reaches its breaking point first. And when the trigger fires, it won't look like a single dramatic event. It will look like a series of reactions, small at first, then accelerating quickly. A major institution might announce unexpected losses. A government might declare emergency measures. A major bond auction might fail. A currency might plunge. A central bank might tighten or loosen policy unexpectedly. A country might dump U.S. assets, and markets, already stretched thin and deeply dependent on liquidity, could react violently. In these moments, confidence evaporates. It doesn't fade slowly, it disappears instantly. Investors rush to assets they trust: gold, silver, land, commodities, and even digital assets. The very same assets that have been quietly rising already, telegraphing the shift before the public sees it. But here's the most important part. Collapses don't destroy systems, they reveal them. A collapse doesn't create a new reality. It exposes the truth that was already there. The truth that the dollar's purchasing power had been weakening for years. The truth that unlimited money printing comes with a price. The truth that the world has alternatives for the first time in modern history. The truth that debt cannot grow forever. The truth that confidence is fragile, temporary, and often an illusion. And once exposed, that truth cannot be hidden again. This is why gold and silver are surging. This is why nations are stockpiling. This is why institutions are repositioning. They're not reacting to the events you see on the news. They're preparing for the events you haven't seen yet. There is a sense, subtle but unmistakable, that the era of dollar dominance is entering its late chapter. Not ending tomorrow, not collapsing overnight, but shifting in a way that will transform the financial landscape for decades. The same shifts that once signaled the fall of the British pound, the decline of the franc, the unraveling of empires across history, those signals are appearing again. And yet, the average person feels something different. They feel tighter budgets, shrinking savings, rising prices, declining purchasing power, confusion about why everything is getting more expensive, a sense that the world is changing, but not understanding how fast or how deeply. They feel the symptoms, but not the system. This is the quiet phase before the world realizes what experts already know. Currencies don't collapse when they hit zero, they collapse when people lose trust. Trust is the real currency, and right now, trust is fading. In the final phase of every major monetary shift, one pattern always emerges: a scramble for clarity. People seek answers, markets seek signals. Governments seek control, and history moves faster in a few months than it moved in the previous decade. We are entering that phase now. The question that remains, the one that matters most, is what comes next. What does the world look like if the dollar loses its role as the global anchor? What fills the vacuum? What emerges from the fallout? That's where the story goes next. But here's the part almost nobody talks about, the part that should keep every policymaker up at night. The system isn't just cracking, it's looping. The same mistakes that triggered past currency crises are repeating again. Only this time, the stakes are globally synchronized. For a moment, step back and look at the entire pattern as one continuous sequence. A large empire builds dominance. Debt grows quietly. A shock exposes vulnerabilities. The currency wobbles. Authorities respond with short-term fixes. The fixes create bigger long-term damage. A new shock hits, and the cycle accelerates. This is the rhythm that destroyed the British pound as the world's reserve currency. It's the rhythm that pushed the Roman denarius into hyperinflation. It's the rhythm that Japan fell into in the 1990s, never fully recovering its growth momentum. And it's the rhythm the United States is dangerously close to replaying. Because here's the uncomfortable truth: every rate cut is a message, every surge in gold and silver is a signal, and every drop in purchasing power is a warning. And right now, all three warnings are flashing at the same time. Economists argue endlessly about what actually causes a currency to destabilize, but history shows us that three elements almost always appear right before the breaking point. A sudden shift in monetary policy, a sharp move in alternative stores of value, and a rapid loss of purchasing power that catches the public off guard. And today, we have all three. The Fed's pivot from tightening to cutting is the kind of rapid policy reversal that tells insiders something is wrong beneath the surface. Gold and silver hitting record highs signals that large money, the quiet, cautious, slow-moving giants, are rebalancing out of fiat. And a 10% loss in dollar purchasing power in 6 months means inflation didn't disappear, it only changed shape. The patterns aren't just similar to the past, they are disturbingly aligned. If this were just about inflation, or interest rates, or gold prices rising, then this story would simply be another cycle. But the deeper story, the one hidden under the numbers, is about trust. Trust is the real reserve currency of the world. And once trust begins to decay, everything else follows. You can print new dollars, you can adjust interest rates. You can regulate markets, change rules, issue statements, calm investors. But you cannot print trust, and every time the Fed injects artificial confidence. Every time politicians reassure the public without explaining the root causes. Every time the media paints temporary stability as victory, trust erodes a little more. Currencies don't collapse when a crisis begins. They collapse when people stop believing the solutions will work. That's the moment when the system crosses from unstable to unrecoverable. The dollar is nowhere near catastrophic collapse today, but the pattern we're seeing is the same one that has led other dominant currencies to lose their global role. The fall is slow, invisible, and then suddenly irreversible. From here, there are three possible paths. The first is the soft landing: slow rate cuts, cooling inflation, stabilizing metals, and a dollar that weakens but remains dominant. It's possible, but historically rare. The second path is the acceleration loop: cuts that come too fast, inflation that reawakens, hard assets that explode upward, confidence that wavers, and a long-term decline in the dollar's role. This is the more common path in history. And then there is the trigger event. A geopolitical shock, a credit freeze, a debt rollover failure, or a major foreign holder suddenly reducing U.S. bond exposure. The Fed is forced into rapid rate cuts, inflation spikes, the public realizes purchasing power is slipping faster than expected, and panic spreads from markets to households. This is the path everyone hopes to avoid, but current indicators are raising the probability. There are three key conclusions that emerge from everything happening right now. First, the dollar's decline is not random. It fits a historical pattern that repeats before every major currency weakening. Second, the rise in gold and silver is not accidental. Large institutions are quietly hedging against systemic fragility. And third, rate cuts are not a victory. They are early warnings that something behind the curtain may already be breaking. We are entering a period where financial events won't unfold over generations, they will unfold over years. The world has never been this interconnected, this leveraged, this synchronized, and this fragile. Which means the next trigger event, whenever it comes, will not stay contained. The biggest danger right now is not that the dollar collapses overnight. The biggest danger is the assumption that it can't happen here. Every empire that believed that thought discovered too late what history had been trying to warn them about. So the real question isn't whether the dollar collapses. The real question is, what happens if the rest of the world begins preparing for that possibility before the United States does? Because when trust shifts, markets follow, currencies follow, power follows. And once the shift begins, it doesn't reverse. If this breakdown helped you understand what's happening beneath the surface, the patterns, the warnings, the turning points, then don't just watch the next crisis unfold. Understand it before it arrives. Subscribe for deeper investigations, data-driven breakdowns, and the hidden financial stories the mainstream never explains. This was your deep dive into the trigger event nobody is talking about. Stay aware, stay informed, and I'll see you in the next video.